Most people believe one simple idea. Buying a house makes you richer. It feels obvious. You stop paying rent, you own something, and over time that asset grows in value. But this belief is incomplete, and in many cases it is simply wrong. What most people actually buy is not wealth, but a long-term financial obligation disguised as an asset. When you take a mortgage, you are not just buying a house. You are committing to a multi-decade cash flow contract. Typically, this contract lasts 20 to 30 years. During that time, your income is partially locked. Every month, a portion of your earnings is already assigned before you even see it. This is not ownership in the traditional sense. It is structured dependency. Let's start with the basic numbers. Imagine you buy a house for $400,000. Most people focus on that number. But the real number is not the purchase price. The real number is the total cost of ownership. With a typical mortgage rate over 25-30 years, you will often pay between $700,000 and $900,000 in total, sometimes more. That means the house does not cost $400,000, it costs double. In the early years of a mortgage, most of your monthly payment does not go toward the house itself, it goes to interest. In many cases, 70 to 90% of your payment in the first years is pure interest to the bank. This means that despite paying thousands every month, your actual ownership barely increases. You are not building equity as fast as you think. You are servicing a loan.
Now add the costs people ignore: property taxes, insurance, maintenance, repairs, utilities. These are not optional. A house is not a passive asset. It is an active system that constantly consumes money. Roofs break, pipes leak, appliances fail, paint deteriorates. Every year, something needs fixing. A common rule is that maintenance alone costs around 1 to 2% of the property value per year. On a $400,000 home, that is $4,000 to $8,000 annually. Over 30 years, that becomes another $120,000 to $240,000. This is rarely included when people talk about building wealth through real estate. Now consider taxes and insurance. These costs tend to rise over time. They are not fixed. As property values increase, so do taxes. Insurance premiums adjust with risk, inflation, and market conditions. So your monthly cost is not stable. It grows. At this point, we can summarize something important. The house is not just a purchase. It is a long-term financial drain with multiple layers of cost: mortgage payments, interest, maintenance, taxes, insurance. All of these combine into a continuous outflow of money. Now let's talk about the concept people use to justify all this: appreciation, the idea that the house will increase in value. This is often true over long periods, but appreciation alone does not automatically make the investment good. Why? Because appreciation must be compared against total cost and alternative use of money.
If your house increases from $400,000 to $600,000 over many years, that sounds like a $200,000 gain. But if you paid $800,000 total to own it, your net result is not as impressive as it seems, especially when adjusted for inflation. And there is another factor: opportunity cost. This is the money you could have invested elsewhere. Every dollar tied into your house is a dollar not invested in assets that generate returns. For example, if instead of putting a large down payment and high monthly mortgage payments into a house, you invested that money into diversified assets like index funds, the long-term growth could be significantly higher. Historically, stock markets have returned around 7 to 10% annually over long periods. That compounds. Compounding is critical here. When you invest, your money grows on top of previous growth. When you pay a mortgage, your money is mostly consumed by interest and costs. These are two completely different financial mechanisms. Let's compare two people. One buys a house with high monthly payments. The other rents a cheaper place and invests the difference. Over 20 to 30 years, the investor often ends up with more liquid wealth. Not theoretical equity, but actual accessible money. Liquidity is another major issue. A house is not liquid. You cannot easily access the value inside it. To use that value, you must sell the house or take on more debt through refinancing. Both options have costs and risks.
This becomes critical during emergencies. If you lose your job, your mortgage does not pause. If something unexpected happens, your expenses remain fixed. You cannot easily convert your house into cash to solve short-term problems. This leads to a hidden risk:
financial rigidity. A large mortgage reduces your flexibility. It limits your ability to take risks, change careers, start a business, or relocate. Your decisions become constrained by fixed obligations. This is why many people stay in jobs they do not like, not because they lack ambition, but because they cannot afford to interrupt their income stream. The mortgage requires consistency. It demands stability. It reduces optionality. Now, let's address another belief. At least I'm not wasting money on rent. This is one of the most common arguments, but it is based on a misunderstanding. Rent is not wasted money. Rent is the cost of flexibility. When you rent, you pay for a place to live without long-term commitment. You transfer maintenance risk to the owner. You avoid large upfront costs. You maintain mobility. Owning a house replaces rent with a different set of costs: mortgage interest, maintenance, taxes, insurance. The difference is not that one is waste and the other is investment. The difference is structure.
In fact, in many markets, the unrecoverable costs of owning, meaning interest, maintenance, taxes, can be comparable to or even higher than rent. The difference is that ownership also includes a forced savings component through principal payments, but that comes with reduced flexibility. Another key issue is time. A 30-year mortgage is not just a financial decision, it is a life decision. Over 30 years, your situation will change. Your income may change, your priorities will change, your location preferences may change. Locking yourself into a long-term property assumes stability that rarely exists. This creates friction. Selling a house is not instant. It involves transaction costs, fees, market timing, and uncertainty. Now, let's talk about leverage. A mortgage is a form of leverage. You are using borrowed money to acquire an asset. Leverage amplifies outcomes. If prices go up, your gains are amplified. But if prices stagnate or fall, your risks are also amplified. During certain periods, real estate markets stagnate for years. In those cases, the expected appreciation does not materialize while the costs continue. This can significantly reduce the overall return. Another overlooked factor is inflation. While inflation can increase property values, it also increases costs. Maintenance, taxes, insurance, and interest rates are all influenced by inflation, so the benefit is not one-directional. Now let's bring everything together. The idea that a house equals wealth is an oversimplification. A house can be part of a financial strategy, but it is not automatically a good investment.
In many cases, especially when bought at the limit of affordability, a house behaves more like a liability than an asset. It consumes cash flow, reduces flexibility, and delays investment in higher return assets. So what is the alternative? The answer is not never buy a house. The answer is to understand the trade-offs clearly. A house becomes a better financial decision when the total cost is manageable relative to income, the time horizon is long enough to absorb transaction costs, the opportunity cost is considered, and the purchase is not driven by emotional pressure. One practical approach is to reduce the size of the commitment. A smaller house means lower payments, lower maintenance, and more flexibility. This frees up cash flow for investing. Another approach is to delay buying until your financial base is strong. Instead of stretching to buy early, building investments first can create more stability. The key shift is this: stop viewing a house as the primary path to wealth. Start viewing it as a lifestyle choice with financial consequences. Wealth is built through consistent positive cash flow and compounding investments, not through locking yourself into long-term debt under the assumption that prices will always rise. At the end, the question is not, is owning better than renting? The question is, what gives me the best long-term financial position with the highest flexibility? Because real wealth is not just about what you own, it is about what you control, and more importantly, what you are free to do. If your house limits your choices, consumes your income, and prevents you from investing, then it is not making you richer, it is making you dependent, and that is the illusion.